Assalamu alaikum friends, welcome to part 2 of IFRS 15 revenue. So here we are going to discuss the remaining part and let us know contract modifications. When contracts are modified, what should we do? Because we know that contracts are not always, it does not remain fixed all the time, right? There are times, there are situations where the contracts are modified. So in that situation, how do you recognize revenue? Okay. A contract modification is a change in scope or the price of a contract. Maybe the scope of the contract might have changed or even the price. So the modification is accounted for as a separate contract. So when you modify, that is known as separate contract. If two things are there, the scope of the contract increases because of the addition of distinct goods or services. That means now more goods and services has been put in that contract, which are distinct. That means performance obligation is more now. Next, so the scope is increased. Next, the price increases by an amount that reflects the standalone selling price of the additional goods or services. Okay, so you can tell that for the additional goods and services, let's say there are three different goods. For all the three different goods, the price is given. That price reflects it, the price for additional goods and services. Therefore, the price increased. So either the scope and the price. If this increases, then it is known as a separate contract. If not accounted for as a separate contract, the modification will be accounted for as. So if it is accounted, there are two things when a contract is modified, whether it is accounted as a separate contract or not. Okay, if it is not accounted as a separate contract, the modification will be accounted for as such. Okay, two things are just okay. So these are the two things. If it is not accounted for as a separate contract, the termination of the existing contract and the creation of a new contract. If the remaining goods are distinct from those transferred before the modification. Okay, so before the modification, the remaining goods are distinct from those transferred. In that case, existing contract terminates and a new contract starts. They are not two separate contracts, it is one contract. What happened is the old one now existed, now we are going to go by the new law, the new contract. So the transaction price of this new contract is the total of the original consideration unrecognized and the additional consideration promised from the modification. You add this to. That is the transaction price of the new contract. You add this to. The original consideration. Original means the existing contract before you created a new contract. For that old contract, whatever the consideration you are going to receive, which was not recognized now, it is unrecognized. So that amount plus the additional consideration that you have been promised from the modification. Okay, so this you add, that is the total transaction price. Part of the original contract. Okay, this is when the termination of the existing contract and the creation of a new contract. The other one is it is a part of the original contract. If the remaining goods and services are not distinct from those transferred before the modification, that means goods and services are similar to that which has been there before the modification, then it so form part of a single performance obligation. It is not treated as a separate performance obligation. So this modification will impact the contract price and the stages of contract completion. Yes, the contract price will be affected, and also the stage of contract completion. It is dealt with by adjusting the amount of cumulative revenue recognized at the modification date. What do? You adjust whatever the revenue you have calculated, recognized at the modification date. You have to adjust it because it is now a part of the original contract. When is it a part of the original contract? That means even though it modified, no new contract is there. It is a part of the original contract only. So whatever the revenue you have recognized under the original contract, you change it. Okay, because the goods and services under the modification are not they are not distinct. They are not different from the goods and services which was there before the modification. So it is a part of the original contract. But if it was different, then it is known as termination of existing contract and creation of new contract. Then this is the way you have to calculate your transaction price. So make sure that you know these two things. Now, examples of modifications. Remaining goods and services not distinct. So that is the second thing. That means that is a part of a existing contract. This falls in the second category, right? The reporting entity, a construction company, enters into a contract to construct a commercial building for another company. 1 year later, both companies agree to modify the contract by changing the floor plan of the building. This results in an increase to the contract price. Because definitely, if you are changing the floor plan of the building, this will increase the cost of the contract. So the remaining goods and services to be provided under the modified contract are not distinct from goods services transferred before the date of the contract modification. You see why? Because even though you change the floor plan, you modify the contract, at the end you are still going to give them a building only, the commercial building only you're going to provide them, because your object performance obligation was to construct a commercial building. It is same before and after. So this is because the contract still contains one performance obligation to construct a commercial building. This is the one performance obligation before and after modification. Therefore, this is known as part of the original contract. This change in the flow plan. So consequently, the reporting entity accounts for the contract modification as if it was the part of the original contract. A cumulative catch-up adjustments will be required. What do you adjust? You adjust your revenue, what you have currently recorded. That you need to adjust. Then we have contract cost. Contract modification is over. Now let us go to the contract cost. Because the name is revenue with contracts from customer. So we have to know the prices of contracts and all. The cost of what? Cost is important. That's why we are studying this contract cost under IFRS 15. It is not just revenue, it is revenue from contract with customers. Understanding? So whenever you have a contract from the customer, how do you recognize revenue? It is this is the standard. So contract cost will definitely come. So they say the following cost must be recognized as an asset. That means you have to capitalize this cost under the contract. What is it? The cost of obtaining a contract. So what are the costs required for you to get that contract? You can capitalize it as an asset. But remember, some costs are excluded from that, such as this must exclude cost that would have been incurred regardless of whether the contract was obtained or not. Some costs, whether you obtain the contract or you don't obtain the contract, you will be incurring those costs. Those costs you cannot capitalize. Okay. For example, legal fees or cost of traveling to a tender. Right? So this legal fees will be there, also cost of traveling to a tender. See, when you travel to the tender, it does not mean you get the contract, right? You might get the contract, you might not get the contract. So the cost of traveling to a tender, that you cannot avoid it. It is there. It will be there, incurred. So that you cannot add it with the, you cannot capitalize this cost and say that this is a contract cost. No. It's just an expense. Same for the legal fees. Only those costs which is specifically they incur for you to obtain the contract. Only those costs you can capitalize. So the cost of fulfilling a contract. The other one is obtaining a contract. The other one is fulfilling a contract. Remember, when you fulfill a contract, also there are costs to it. So cost of fulfilling a contract if they do not fall within the scope of another standard. What does it mean? For example, IS2. If they fall under IS2, you don't capitalize it. It is dealt under IS2. But if it should not fall in the scope of another standard. That's what they mean. It should fall under the scope of IFRS 15. Then whatever the cost of fulfilling a contract, you capitalize. Okay, and the entity expects them to be recovered. The entity also should expect them to be recovered, whatever the cost they have incurred in fulfilling the contract. For example, they have fulfilled a contract. Okay, that means they have agreed a contract to build a building, commercial building. So after 5 years, it took 5 years. So they build the building. After 5 years, they hand it over to their client. So that is the contract cost. They were fulfilling the contract for this 5 years. They were making floors, they were building, they were putting wires, they were installing equipments. All those things are the cost of fulfilling those contracts. So this will be recovered how? By the amount they are going to receive at the end of the 5th year from their client. Right? So this is how they recognize. So this is capitalized, okay, as a contract cost. It is recognized as an asset. Okay, the following cost must be, they are recognized as an asset. This cost. The cost of obtaining a contract, the cost of fulfilling a contract. You have to also expect them to be recovered also. If you don't expect them to be recovered, then you cannot capitalize it as an asset. So the capital as cost of obtaining and fulfilling a contract will be amortized to statement of profit and loss as revenue is recognized. This will be amortized. The capitalized cost. So once you are capitalized, the cost of obtaining and fulfilling a contract, what's next? It will be amortized to statement of profit as revenue is recognized. It will be amortized. Why is it amortized? Because we know only intangible assets are amortized. Why is this is amortized? Because this cost of obtaining and fulfilling a contract, it is recognized as what? As an asset. But this asset, you cannot, it's not tangible asset, right? You don't recognize, this is not a tangible asset. Whatever the cost, these are just cost which you have capitalized. So they are not tangible asset. So that's why you are amortized. So based on that, okay, that is the idea why they are telling to amortize. So we consider them as intangible assets. That's why you are amortizing this. Okay, so because you recognize this and recognized it as an asset in your statement of financial position. Remember, when something is recognized as an asset, tangible or intangible. If it's tangible, you have to depreciate it. If it's intangible, you amortize it. So here you amortize the contract cost. Contract cost includes two types of cost: cost of obtaining a contract and also cost of fulfilling a contract. Okay, it will be amortized as revenue is recognized. When you recognize the revenue, that time you amortize this one also. Cost of obtaining and fulfilling a contract, the capitalized cost. So general cost and cost of wasted labor materials are expense to profit and losses incurred. Okay, now let us go to the presentation of on the statement of financial position. How do you present it? So when an entity has recognized revenue before it has received consideration, then it should recognize either two things. In this case, what are they doing? They are recognizing the revenue before they are receiving the cash, receiving consideration. Then it should either do one of the following, this or that. A receivable if the right to the consideration is unconditional. It is recognized as a receivable. How normally when you sell on credit, you haven't received cash from your customer, you receive it as a receivable. Same way. Here also you receive it as a receivable. Because you haven't received the consideration yet, but you recognize the revenue. You are yet to receive the consideration. So you recognize it as a receivable in your statement of financial position. If the right to consideration is unconditional, what do you mean unconditional? It cannot be conditional on something. If it is conditional on something, conditional, then it is not receivable. Okay, so right to the consideration is unconditional. No matter what happens, it is not, there are no limitations, there are no conditions attached to it. You will have that right to receive the consideration. So it is a receivable, or you recognize it as a contract asset. Okay, because you have recognized the revenue. So in the statement of financial position, you need to recognize the asset. You have credited a revenue, you need to debit it somewhere, no? So you debit it as a contract asset in the statement of financial position. So you record it as a contract asset. One of the two things. But this is only if you haven't received the consideration yet before receiving it. You have recognized the revenue, then only. An entity has an unconditional right to receive consideration if only the passage of time is required before payment is due. Okay. Unconditional means what? They will have unconditional right only when the passage of time is required before payment is due. That means some time has to pass by before the payment is there. Before actually you receive the payment. Some time should have been passed. Then that is known as unconditional right. Okay, a current liability should be recognized if the entity has received the consideration or has an unconditional right to receive the consideration before the related revenue has been recognized. What if it's the other way around? You receive the consideration before you recognize the revenue. Then Okay, so entity received the consideration. You already have received your cash before you actually made the sales. It's like that. So before you received consideration, but you haven't recognized the revenue yet, then what? Then recognize it as a current liability. Current liability. Okay, because you have received cash before you have recognized revenue. So if revenue is recognized before receiving consideration, contract asset. If consideration is received before recognizing revenue, contract liability. Okay. Now let us go to the disclosure. They require entity to disclose these three things. What is it? Revenue recognized from contract with customer, contract balances and assets recognized from costs incurred obtaining or fulfilling contract. This is also important. Why? Because it's easy that most of the items which are expense, they might capitalize it as contract, right? Cost from obtaining or fulfilling contract. Not all cost of obtaining or fulfilling contracts can be capitalized as contract asset, but they might do it. That's why they need disclosure of it. How much of it is from obtaining and fulfilling contract, and how much is recognized as an asset that is capitalized. Significant judgments made and any changes in judgments. There are judgments made sometimes because this type of areas are risky when you have contracts and all, and especially when it's for long time. For example, construction of building and all, anything can happen. They might not fulfill, they might not receive the consideration. So what are the judgments you have used, and if the judgments changed, that needs to be disclosed. Now let us go to the judgment, and this is the last section of IFRS 15. After that we'll be doing questions. So throughout the revenue recognition you need management judgment. Okay, so that's why there is this section on judgment itself. 1 2 3 4 5 6 7. Contracts with customers do not need to be in writing. Okay, that was, it's a normal assumption that most of the time is not in writing. It might not need be. It can be, but it cannot be. But it's not compulsory. But may arise through customary business practice, right? Maybe if you have, or in the history you have that policy of writing it down, then you can. An entity must therefore ascertain whether it has a constructive obligation to deliver good or service to a customer. Because it is not in writing, what should they do? They are making a judgment here. Okay, that they have a constructive obligation to deliver the good or service to a customer. They are ascertaining it because it is not in writing. If it was in writing, it must be very clear that yes, there is an obligation. But now they are ascertaining it. They are assuming that there is an obligation from the entity that they have to deliver the good or service to the customer. So a judgment has been used here. What was the judgment? Judgment that they have the constructive obligation. Second, a contract can only be accounted for if it is probable that the entity will collect the consideration that it is entitled to. Whether benefits are probable, it is ultimately a judgment. So this is based on something probability. Probability itself is a judgment. You are putting some percentages that okay, this we are sure that this much, this is the percentage. Let's say we are sure that 30% we will receive the consideration from the customer. It's just a probability you're putting, and that itself is a judgment. Third, an entity must identify distinct performance obligations in a contract. However, past performances may give rise to expectations in a customer that goods or services not specified in the contract will be transferred. There might be in the past that some goods and services which are not there in the contract, they are transferred to the customer. So they are assuming that here this time also goods and services which are not specified in the contract will be transferred to the customer. Expectations are there, right? If something happens in the history, it is common, it's very common that even now also you can expect that same thing to repeat. So the identification of distinct performance obligation thus relies on the management judgment about both contract terms and the impact of the entity's past behavior on customers' expectations. Next, variable consideration. Variable consideration should be included in the transaction price. If it is highly probable, here also you are using the word probable. Wherever the word probable is, judgment is used there. Significant reversal in the amount of cumulative revenue recognized to date will not occur. This may involve making judgments about whether performance-related targets will be met. Okay. Transaction price must be allocated to distinct performance obligation based on observable standalone selling prices. You just cannot divide the transaction prices between 2 or 3 performance obligations. It needs to be based on some observable standalone selling prices. However, estimation techniques must be used if observable prices are not available. Sometimes you cannot just observe the prices, they might not be there. That time you have to estimate it. So, estimation techniques is a judgment area. If a performance obligation is satisfied over time, then what? If a performance obligation is satisfied over time, revenue is recognized based on progress towards the completion of the performance obligation. There are various ways to measure that completion using either input or output method. We have seen previously in part 1. And the entity must determine which one most faithfully represents the transaction. So entity must decide that time whether they will go by the input method or the output method to see how much it is completed. So there itself is a choice. They're using their judgment. Input, output. The method is different, right? If a performance obligation is satisfied at a point in time, this is over time, this is at a point in time, the entity must use judgment to ascertain the date at which control of the asset passes to the customer. So that date also they estimate that this day the control shall pass to the customer. This judgment increases the risk that the management of an entity could manipulate its profit. See, revenue is one of the area. Even the auditors will be using so many of tests to check that, because that is an area which is highly manipulated. Risk is high there. So this is very important even for your AAA, because so many judgments. Even this can come as an ethical question also, revenue recognition. So make sure that when you are studying IFRS 15, you study from various perspectives, ethical perspective, accounting perspective, auditing perspective. So this question has a very huge chance of appearing for your September exam. Finally, we are now summarizing whatever we have covered in both part 1 and 2 before I actually start doing questions. Okay, so we went through the 5-step approach to revenue recognition. First, we identify a contract. Second, we performance obligation we identify. Third, transaction price is determined. Fourth, we allocate the transaction price to the performance obligation. Performance obligation might be more than one. Then finally, we recognize revenue. Then we went to contract cost. So we capitalize the cost of fulfilling the contract and also obtaining the contract. Some of the cost we capitalize it. So presentation, it might be shown as a current assets or a contract assets or a contract liabilities based on whether your revenue was recognized earlier than your consideration received, or your consideration received was recognized before you recognize revenue. Then finally we went to disclosure, what needs to be disclosed, and we went through some judgments. So now we'll be starting with test your understanding 1, right? We'll be doing all your test and understanding. So we are officially over with IFRS 15. Test understanding 1. On 1st December 2001, Bristow provides a service to a customer for the next 12 months. The consideration is 12 million. Bristow is entitled to an extra 3 million if after 12 months number of mistakes made falls below a certain threshold. Okay, so the consideration is 12 million and extra 3 million it's a conditional consideration which is based if the number of the mistakes falls below a certain threshold. Discuss the correct accounting treatment for the above. A. Bristow has experience of providing identical services in the past, and it is highly probable that the number of the mistakes made will fall below the acceptable threshold. B. Bristow has no experience of providing the service and is unsure whether they can reduce the mistake below the threshold or not. Okay, so let us first do with A. The 12 million, this consideration is fixed, right? That 12 million, this is fixed. But what about the 3 million? It's variable consideration. It is known as a variable because it might vary. You might receive, you might not receive. So the 3 million consideration is dependent on the number of mistakes made and is variable. If something is dependent on something, that consideration becomes variable. Must estimate the variable consideration. It could use an expected value or most likely amount. Since there are only two outcomes, 0 or 3 million, then a most likely amount would better predict the entitled consideration. Now let us go by A. So best express to hit the target. Using a most likely amount, the variable consideration would be 3 million, right? They are most likely to reduce the mistake below a certain threshold. So that means they are going to receive this 3 million. They will be entitled. Bristow must then decide to whether include the estimate of the variable consideration in the transaction price. Should you add this 3 with 12 million or not? So based on the past experience, it seems highly probable the significant reversal in the revenue recognized would not occur. Right? This means the transaction price you can add. So it becomes 15 million. As a service, it is likely that the performance obligation would be satisfied over time. Look at the word, it's a service, it's not a good. So services are mostly, they are satisfied over time. So the revenue will be recognized over time. So you just have to take 1 month. Okay, so this will be divided over 12. Per month it will be this 1.25 million because this 15 will be divided by 12. Now let us go to B. It is estimated that they will not hit the target. So it could be 0 or 3 million. Now, whatever the amount estimated variable consideration cannot be included. So this now cannot be included in the transaction price. Okay, because it is not probable that a significant reversal in revenue would not occur. This is because business has no experience of providing these services. They do not have experience. So the probability is also less. So this is the transaction price and this only will be divided by 12. So now it will be 1 million. This is the revenue recognized. Now let us go to B. Now the one enters into 50 contracts with customers. Each contract includes the sale of one product for 1,000. The cost to nadir of each product is 400. Cash is received upfront and control of the product delivers on delivery. Transfers on delivery. Customers can return the product within 30 days. They can return. To receive a full refund, Nowden can sell the returned products at a profit. Nowden has a significant experience in estimating returns for this product. It estimates that 48 products will not be returned. How should the above transaction be accounted for? So the fact that the customer can return the product means that the consideration is variable. Remember under part 1 when we were going through it, which considerations are variable. So one of it was when you can return it. Okay, that consideration is variable. So using an expected value method, the estimated variable consideration, okay, they are using an expected value method. What is the estimated variable consideration? It is 48,000 because 48 products and 1,000 you are going to receive for each. So the variable consideration should be included in the transaction price. Why should it be included? Because it is based on Nowden's experience. That it is highly probable that a significant reversal in the cumulative amount of revenue recognized will not occur. 48,000. See, whenever in the past you have a high experience of that returns, goods will be returned. Okay, goods will not be returned. Sorry. Then it's better that you can include that in your transaction price, the variable consideration. If they do not have an experience, then do not include. So therefore the revenue 48,000 and refund liability. This is the revenue and a refund liability of 2,000. Why? 1,000 into 2 expected to be returned should be recognized. This is expected to be returned, this 2,000. So that what is expected to be returned is known as refund liability. This also should be recognized. Okay. Let us see. 2 into 1,000. How much are they going to return? $48 products. So you see they have entered into 50 contracts, right? And 48 will not be returned. That means 2 will be returned, right? So 2 into 1,000. Now Norden will de-recognize the inventory transferred to its subsidiary. What should it do? It should de-recognize the inventory that it has transferred to its customers. However, it should recognize an asset of this as well as corresponding credit to cost of sales for its right to recover products from customers on settling the refund liability. So because when they settle the refund liability, they have the right to recover the product from the customer. Therefore, they should recognize 800 as an asset. Why? Two products that are returned. What is the cost of it? The cost is 400. So 2 into 400. 800 they should recognize as an asset, and it should be credited from the cost of sales. Next, we are going to 3. Rude enters into a contract with the customer to sell equipment on 31st. This is sell equipment. Control of the equipment transferred to the customer on that date. On 31st December only, control is transferred. Price is stated as 1 million and it is due on 31st December 2003. Due on. That means that equipment. So the market rates of interest available on the particular customers are 10%. Explain how the transaction should be accounted in the financial statements for 31st December 2001. Due to the length of the time between the transfer of control of the asset and the payment date, you see, you have been transferring it in 31st December 2001, but the payment date is different. That means because there's a difference, this includes a significant financing component. In part 1 of this video, we have gone through what is financing component. So the transaction must be adjusted for the impact of the financing transaction. You have to adjust it, the consideration, because of this financing part there. What is it? A discount rate, 10%. So revenue should be recognized when the performance obligation is satisfied. As such, revenue and the corresponding receivable. So you have to recognize revenue as well as corresponding receivable. Remember, when there's a significant financing component is there, revenue also you have to recognize as well as receivable, because you are not being paid. You are transferring it to the customer, but you are being paid after 2 years. You'll be paid after 2 years. So you have to find the present value of it. And you have been given the discount, the interest rate as 10%. So using that, you have to find the present value of that 1 million that you are supposed to receive. So this much should be recognized because you are discounting this 1 million. 1 divided by 1.110 because 10% and to the power 2 because it will be receivable in 31st December 2003 after 2 years from 31st December 2001. But on 31st December 2001, you have to find the present value of it. This 1 million is given in terms of the future value. So the receivable is subsequently accounted for in accordance with IFRS. So the receivable part, it is dealt under IFRS 9. Okay. Now let us go to test understanding 4. Dan sold a good to Stein. Control over the good was transferred on 1st of Jan. Take control. It's very important that you should know at which day the control passed to the customer. So the control on 1st of Jan 2001. The consideration received by Dan was 1000 shares. You see, consideration need not be all the times in cash. So this is the consideration which is 1000 shares in Stein with a fair value of 4 each. 31st December 2001, the shares in Stein had a value of 5. So from 4 it has increased to 5. How this should be recognized? The revenue should be recognized. So the contract contains a single performance obligation. Considered for the cash is non-cash. Non-cash is measured at fair value. We know that revenue should be recognized at 4,000. 1,000 at 4 on this date. What about the later date? What about 31st December 2001? Any subsequent change in the fair value, we saw from 4 it has increased to 5, of the shares received is not recognized within revenue. You see, it is not recognized within revenue if the fair value changes. Where will it be accounted for instead? IFRS 9. So when we go through IFRS 9, you need to come back here and see to understand the impact. Because a part of revenue we have in IFRS 9 also. Okay? But instead accounted for in accordance with IFRS 9, that increase in fair value. Now let us go to 5. Golden Gate enters into a contract with a major chain of retail stores. The customer commits to buy at least 20 million of products over the next 12 months. Over the next 12 months. So this word says that it's not at a point in time. The terms of the contract requires Golden to make a payment of 1 million to compensate the customer for changes that it will need to make to his retail stores to accommodate the product. So they have made some changes. That's why payment is they need to make payment of 1 million to compensate the customer for the changes. By 31st December 2001, the Golden Gate has transferred products with the sales value of 4 to the customer. What is it? 4 million to the customer. How much revenue should be recognized on 31st December 2001? The payment made to the customer is not in exchange for a distinct good or service. We'll see. What is it relating to? It is major chain of retail stores. Okay. And customer for changes that it will need to make to its retail stores to accommodate the products. So the good, so after this is like a contract modification. You're not making any changes. There are no distinct goods and services after the modification. You're understanding? So the payment made to the customer is not in exchange for a distinct good or service. Therefore, what should you do? You should reduce this from a transaction price. Okay, this rule is there in part 1 of this video. So if you are not understanding this, you need to go back to part 1, where they say that if the payment made to the customer is not in exchange of a distinct good or service, what should you do? You should reduce that price from the transaction price. So this 1 million paid to the customer should be shown as a reduction in the transaction price. What is the total transaction price? Is essentially being reduced by 5%, 1 over 20. Okay, 20 million is the transaction price, 1 million you are paying to the customer, so that needs to be, so in terms of percentage, it's 5%. It will reduce. Therefore, Golden Gate reduce the price allocated to each good by 5% as it is transferred. So they are reducing their prices allocated to each good by 5% as it is transferred when they are transferring the good. Okay. 31st December 2001, what happens? Golden Gate should have recognized the revenue of how much? 3.8, because you are reducing 5%. So don't say it's 20 minus 119. No, you have to find like this. You need to find this percentage, in fact. That reduction, you need to find this percentage, this 95%. And this 95%, how you will get it? Because it's a reduction of 5%, 1 over 20. How much are you reducing? 1 over 20. So 1 over 25%. So from 100 is 5% you deduct, which is 95%. 95% on 4 million. This is how you are getting the revenue. Even for the other questions also, you need to do like this. Then we are going to 6. Stretch sells a machine and 1 year's free technical support for 100,000. What does he do? He sells a machine and also 1 year's free technical support for 100,000. The sale of the machine and the provision of the technical support have been identified as separate performance obligation. Okay. One is technical support, the other one is machine. Shred usually sells one machine for how much? 95,000. Okay, sells, and but it has not yet started selling technical support for this machine as a standalone product. Other support services offers by Shred attract a markup of 50%. Other support services. It is expected that technical support will cost Shred 20,000. So how much of the transaction price should be allocated to the machine and how much of it should be allocated to the technical support, right? Selling price of machine is 95,000 based on observable evidence. So there is no observable selling price for the technical support, but therefore they are estimated. So as a result, what happened? A residual approach would attribute to 5,000 only. Total was 100 transaction price. From that, 95,000 is for machinery, so you deduct, and 5,000. So you can say 5,000 goes to the technical support. However, this does not approximate the standalone selling price of similar services, which normally makes a profit. But if you compare it with the other similar services, their standalone selling price is not close to 5,000 because they are making profit. So a better approach for estimate. So this is not a good approach, the residual approach. A better approach for estimating the selling price with the technical support would be an expected cost plus a margin, a markup approach. Based on this, the selling price of the service would be. So you here directly you are not given the selling price. You need to find out the selling price of service. Okay, how are you finding it? 150 to 20,000. So they told that they expected, this is like an estimate, that 20,000 and markup is 50%. So you're adding 50% with the cost. Cost is 100, markup is 50. That's why 150% of 20,000, which is 30,000. So you can say that this will be the selling price of for technical support, 30,000. Okay, the total of the standalone selling price of the machine and the support is now 95 plus 30, 125. However, total consideration receivable is only 100,000, isn't it? This means that the customer is receiving a discount for purchasing a bundle of goods and services of 20%. What does it mean? Even though prices are 120, but the total consideration receivable is only 100,000. This means customer is receiving a discount. What is costing 125,000 you are giving to the customer, customer will be paying you 100,000. You understanding? So that means you are reducing the prices and giving to the customer. So that means customer is receiving a discount for purchasing a bundle of goods and services. Bundle because the good and also the technical support you are receiving, right? What is it? You are receiving the machine plus the 1 year's technical support. So it's like a bundle together. They are in one. They are like in a package you are giving. So because of that package, you are giving discount to your customer. So what is that discount? 25 over 125,000, right? 125 minus 20, 100 is 25 divided by 125,000, which is 20% discount. You need to find divide by 125, not 100,000. Okay, because if you find over 100, then it will be 25% discount. No, 125. So now, because price reduced from 125 to 120, sorry, 125 to 100. So the old price is 125. That's why you need to divide by 125,000. So it's 20% discount. So IFRS 15 assumes that discounts relate to all performance obligation, right? Within a contract. So unless evidence exists to the contrary. So the transaction price allocated to the machine will be how much? You need to allocate to the machine as well, and also to the technical support. After discount is 20%. That means after discount it will be 80% of 95,000 and 80% of 30,000. To 24 and 76. So the revenue will be recognized when all the performance obligations are satisfied. Whenever it is satisfied, revenue you can recognize. 7. On 1st Jan 2001, even enters into a contract with the customer to provide monthly payroll services, charges 120,000 per year. So we know that payroll services are a single performance obligation. This performance obligation is satisfied over a time because the customer simultaneously receives also and consumes the benefit of the payroll processing. So this is evidenced by the fact that payroll services will not need to be reperformed if the customer changes payroll service provider. Right? How do you understand it? That they will get the benefit because they do not have to reperformed. If the customer changes payroll service provider, you can change your payroll service provider and it will keep on starting from where the previous one has stopped. So evidence must therefore recognize revenue from the service over time. Okay, remember always in the exam if they give you to recognize revenue, you need to understand what type of the good or service is it. Is it a good or is it a service? Service, if it's service, then it is over time. If it's good, you need to decide whether is it at point of time or over a time. If it's over a time, you need to spread it over a time. You need to recognize revenue like that. Okay. So service over time in the year ended they would recognize revenue of how much? 6 months only, 30th June 2001 for 31st December 2001 of 120,000. Okay, because the payroll was 120,000 was the cost per year on 1st of Jan. So, but 30th June after 6 months. Okay, look at the date they are asking for. They are asking for 30th June. At this date, only 6 months of 120,000 will be taken as revenue. Next 8. On 31st March 2001. Okay. On 31st March 2001. Crawford enters into a contract to construct a specialized factory for a customer. So the nature is specialized factory, and the customer paid an upfront deposit which is only refundable if Crawford fails to complete construction in line with the contract. Then only they have to give this back to the customer, the upfront deposit. The remainder of the price is payable when the customer takes possession of the factory. The remainder will be payable when the customer takes the ownership of the factory. If the customer defaults on the contract before the completion of the factory, Crawford only has the right to retain the deposit. Okay, in case customer is not able to pay before the factory is completed, they default on the payment. What happens? The entity only has the right to retain the deposit. They will retain the deposit. They will not give back that deposit to the customer. They cannot say, okay, we want the full transaction price. If the customer defaults, they cannot. So should they recognize revenue from the above transaction over a point of time or at a point in time? It's a very good question. In assessing whether revenue is recorded over time, it is important to note that the factory under construction is specialized. Therefore, the asset being created has no alternative use to the entity. It has no alternative use. You only have to use it for that purpose. However, Crawford only has the enforceable right to the deposit. They only have the enforceable right to the deposit received, and therefore does not have the right to the payment for the work completed today. So even if they have completed the factory, they do not have the right to the payment for the work completed because the customer defaulted. So consequently, Crawford must account for the sale. How much they should account for it? For the sale of the unit as a performance obligation satisfied at a point in time, because to be to account the performance obligation satisfied over a period of time, or to recognize revenue over a period of time, the above criteria needs to be satisfied. For example, the asset should not be specialized, and they should have the enforceable right to receive the full transaction price, right? Because it is not, the 2 points above are not satisfied, so it is recognized at a point in time rather than over the time. So revenue will most likely to be recognized when the customer takes possession of the factory. So when are you going to recognize revenue? When the customer takes the possession of the factory. Although a detailed assessment should be made of that date when the customer assumes the control. So they didn't give the date when the customer will take the control. So that's why more cannot be said on it. Ninth. On 1st Jan 2001. Okay. Uh, okay. On 1st Jan 2001, Baker enters into a contract with the customer to construct a specialized building for consideration of 2 million. Again, it's a specialized building for a consideration of 2 million. Plus a bonus of 0.4 million. Now there's a bonus also. If the building is completed within 18 months, estimated cost to construct the building will be 1.5 million. This is the cost. If the contract is terminated by the customer, Baker can only demand the payment for the cost incurred to date. Whatever the cost incurred up to that date when the customer has stopped them, plus a markup of 30% only, they have the right. They can demand the payment. On 1st Jan 2001, as a result of the factors outside of its control, such as the weather and the regulatory approval, Baker is not sure whether the bonus will be. So he's not sure whether the bonus will be achieved or not. 31st December 2001, Baker is still unsure whether the bonus. He's still unsure whether he can meet the bonus or not. So he decides to measure progress towards completion based on the cost incurred. You see, there are two methods you can measure your progress towards completion. One is known as input, one is known as output method. Output method is not a good one here because you cannot complete it due to other factors and all. But input, yes, whatever the cost you have incurred. So based on the cost incurred, they will now measure it. So cost incurred on the contract to the date is 1 million. How are they going to recognize it? So constructing the building is a single performance obligation. First, you need to identify how many performance obligation is there. This is a single performance obligation. Constructing, just construct the building. The bonus, what is a bonus? You should know it's a variable consideration. Whatever the estimated value, it must be excluded from, this must be excluded. Whatever the value is, whether it's huge, whether small, does not matter, but it must be excluded from the transaction price. Why? Because it is not probable, highly probable, that a significant reversal in the amount of cumulative revenue will not occur. So the construction of the building should be accounted for as an obligation settled over time. Yes, definitely construction of building is an overtime. So this is because the building has no alternative use for Baker because it is specialized. So, and because the payment can be enforced for the work completed to date. Okay, first of all, it has no alternative uses. That's why it is overtime. And the other one is they can payment can be enforced for the work completed to date. So settle overtime. Baker should recognize revenue based on the progress towards satisfaction of the performance satisfaction of the construction of the building. Using cost incurred, the performance obligation is 2/3 completed. How? 1 divided by 1.5. How 1 divided by 1.5? Accordingly, the revenue and the costs recognized at the end of the year as follows. 1 divided by 1.5. So the cost incurred up to that date was 1, right? But the estimated total cost was 1.5. So out of 1.5, cost incurred was 1. So 1 divided by 1.5, 2/3. 2/3 is completed. So now everything will be 2/3, 2/3. Revenue will be 2/3, cost will be 2/3. So revenue was 2 million and cost was 1.5. Out of that, 2/3 you have taken. So 1, 1.3. So total, this is the gross profit, 0.3. Now let us go to 10. On 31st December 2001, Clarence delivered the January edition of a magazine with a total sales value of 100,000 to a supermarket chain. Legal title remains with Clarence until the supermarket sells the magazine to the end customer. Legal title remains with whom? Clarence. The supermarket will start selling the magazine to its customer by on 1st Jan 2002. Any vaccines that remain unsold by the supermarket on 31st are returned to clearance. The supermarket will be invoiced by clearance in February 2002 based on the difference between the number of issues they receive and the number of issues that they return. So how should they recognize revenue on 31st December 2001? So the performance obligation is not satisfied over time because the supermarket does not simultaneously receive and benefit from the asset. Yes, this is not satisfaction over time. It's at a point in time because simultaneously the supermarket they cannot receive and benefit from the asset. They cannot receive the asset and benefit from the asset simultaneously. Either supermarket has the control of the asset or supermarket does not have the control of the asset. So clearance therefore satisfies the performance obligation at a point in time and will recognize revenue when it transfers. See, when it is at point in time, you need to understand this part. Transfer control comes. First, identify over time or at a point in time. If it is at a point in time, then comes whether control has been transferred to the customer or not. At that time only they will recognize revenue when transfers control over the asset to the supermarket. So the fact the supermarket has physical possession of the magazine, what does he have? He physically have those magazines at this date. It is an indicator that control has passed. Also, clearance will invoice the supermarket for any issues that are stolen, and so the supermarket does bear some of the risk is bared by the supermarket. Because if any issues are stolen, clearance will invoice the supermarket for that. So supermarket has a risk. However, as at 31st December 2001, the legal title, you see, the legal title did not pass. The legal title has not been passed to the supermarket. Moreover, clearance has no right to receive payment until the supermarket says it. So clearance also does not have any right to receive the payment until the supermarket sells the magazine to the end customer. So finally, clearance will send any unsold issues, and so they will bear significant risk of ownership also, such as the risk of obsolescence. What happens? All things considered, it would seem that control of the magazine has not passed. Because remember there were 5 factors to show that control has passed. All 5 has to be there. If one of them is not there, then the control is not passed to the customer. Right? In part 1 we discussed. So here it didn't pass because the legal title didn't pass to the supermarket. Clearance still bears the ownership, right? Some of the ownership, so control didn't pass. Because control didn't pass, can you recognize revenue at a point in time? No, you cannot. So you should not recognize revenue from this contract in the financial statements for this date. Now the 11th. Sally enters into a contract to supply 1,000 products to Sweet for 60 each. 1,000 products for 60 each. The products are transferred over at an 8-month period and control passes on delivery. After Sally had transferred 700 products, the contract is modified to require an additional 200 products to be transferred. That means 1,200 in total. Why? 1,000 from before modification, 200 after modification. The price of the additional 200 is 57 now, which is the standard selling price at the date of the contract modification. By the reporting date, they have transferred 900 products in total to Sweat. So you need to know how are you going to price this 900. Based on the new price or based on the old price? 60 or 57? Okay. Next. A and B. Discuss with calculations how much revenue should be recognized. Now you need to do calculations here to recognize the revenue. B. Again discuss with calculations. So you need to calculate also and discuss also. How much revenue should be recognized in relation to the above by the reporting date? If the contract specified at a price of 40 for the additional 200, okay. If the contract specified a price of 40 for the additional 200 products, assume that the normal standard selling price of the modification date is 57. Okay, at the reporting date, it is a price of 40. That is 31st December. They haven't given you the date. So first let us do A, which should be easy for you. It's a contract modification, right? So the contract modification is accounted for as a separate contract. You need to know whether it will be accounted for as a separate contract or not. Here it is separate contract because the products are distinct. Okay, products are distinct. You can say 200 products for this, 700 products for this. So it's distinct, and the price also increase reflects the product standalone selling price. By the reporting date, control over 900 of the products under the original contract has been transferred. 900 products has been sold. That means control has been transferred to the customer of over 900 products by the reporting date. So how are you going to recognize the revenue? 900 into 60, the original price. The 60 was the before modification price. 900 into 60, hence 54,000 of revenue will be recognized. Again, we'll check that. Okay, so they transfer 900 products. It totals so 900 into 60. Now let us go to the second one. What about the second one? B. The contract price increase does not reflect the standalone selling price of the good. So the modification is not accounted for as here the modification is not accounted for as a separate contract because the goods are distinct. It should be accounted for as a termination of the existing. So because the goods are distinct, it should be terminated as a existing and the creation of new contract. So by the contract modification, 700 goods have been transferred, so the revenue 40,000 recorded, 700 goods. And now the original contract is deemed to be cancelled. A transaction price should be determined for the new contract. So you need to determine the new transaction price for the new contract. This is the unrecognized consideration from the original contracts. How much? 300 into 60. Because 1000, right? Just see. Under the original contract, how many you have sold? 700, right? 700 has been transferred. After they have transferred, the contract is modified. So 700 into 60. So out of this 1000, 700 is sold. That means they are left with 300. So 300 into 60, they didn't recognize. You understanding? So under the original contract, this is not recognized, unrecognized. Plus the additional, so with this you have to add the additional consideration promised from the modification. What is it? 200 into 40. According to B, they have told it's 40 and 200. Because 200 additional this thing. So 26,000. This amounts to a price per product of, so if you go by the price, it will be 52. Because 26,000 divided by 500. How to this 26,000 divided by 500? Why 500? If you want to find price per product. How about the product? Remember, from 1000, I will write it down somewhere. From 1000, 700 is sold. You are left with 300. Now you have additional 200 after modification. So this 300, this 200 will give you 500. Understood? So at the date of the modification, if you want to find the amount price per product, how many products? 500. Price is 26,000 divided by 500 products. So price per product will be 52. Now we are going by after the modification. So after the modification, a further 200 products were transferred to suite. Right? Here they have told. They transferred 900 by the reporting date. By the reporting date, 900 products. That means 700 from the original Okay, and 200 this additional product which has been, so 700 plus 200 gives you 900. You understanding? So that means 200 also you have transferred. So after the modification, this 200 products were also transferred to suite. So you have to recognize the revenue at what? You have got the price per product, which is 52. So 200 into 52, which is this much of revenue you should recognize. So the total revenue recognized in the year is how much? After modification, this one, before modification, 42,000. Okay, the 700 into 60, what you have transferred, this one. Okay, so this and that after modification, this to you add. Okay, next, just to give me a, now the last one. Strangers often offers consultancy services. It's a service, number one. It incurs the following cost on successful contribute. Okay, external fees incurred, research, reputation, customer 30,000, travel cost 20,000, commission to sales staff to winning the bid 15,000. Discuss which of the above costs can be capitalized in accordance with IFRS 15. Capitalized means contract asset, right? Which of this might be recognized as a contract asset? 30, 20, and 50. So if you see, out of this, stranger recognizes an asset of 15,000. Spend on sales commission. This costs were already incurred because the bid was successful. Why do you have sales commission? Only when you have got the bid. The bid was successful. Only after that. That means you have got the bid. Because of that, you are spending on sales commission. That's why this is capitalized. And they will be recovered through the fees earned from the new contract. Okay, so this fees, the sales commission you are giving, you can earn it back from the new contract. So the external research fees and travel cost, they are not. They will anyway be there, whether the contract bid was successful or not. As such, this cost must be expensed to profit and loss as incurred. So that's it for IFRS 15. I hope this shall give you a broad understanding of IFRS 15 now. And also for those students who are having doubt and who are telling me that, ma'am, please make a video on IFRS 15. Please make a video on IFRS 15. So finally, I've made a video on IFRS 15. Right? And make sure that you go through this and more questions. So till then, take care and see you in the next video with some more exciting standards.